Hi, welcome to this video deck, which is all about Forex hedge fund trading strategies. Now, in terms of studying the hedge fund industry, there's a lot you can learn about how to make money and become successful in the Forex market. Now, in terms of hedge funds, there's a lot of misconceptions about how they operate, which I want to go through. Now, in terms of learning from hedge funds, you can learn from the best on certain techniques that are pretty simple that you can implement in your own trading strategy, which will help you win. There's also strategies that hedge funds use to pile up a huge amount of money, but if you try it as a retail trader, you are guaranteed to lose. So you need to avoid those techniques. Now, in terms of learning more about hedge funds, I think any serious trader should. There's 4 books that I would strongly recommend. They are the Hedge Fund Market Wizards by Jack Schwager, The House of Money and the Invisible Hands by Stephen Dromby, and The Hedge Fund Mirage by Stephen Lacker. Now, in relation to hedge funds, I just want to go through a brief history of them as well, because they've changed over the years in the way that they operate. Okay, that mirrors changes in market movement. So let's have a look at their trading techniques and the ones that you can use to help you in your trading strategy, and also the ones to avoid. All right, let's have a look at hedge funds in a little bit of detail and see what we can learn from them. Now, by definition, they invest in a wide range of investments, include stocks, bonds, commodities, also derivatives, particularly complex derivatives, so they're unrestricted. They engage in long and short trading strategies, hence the name hedge funds. They're leveraged, of course. They tend to be less liquid than mutual funds. Compensation is normally a management and performance fee. Typical management 2, typical performance 20. Also, a large percentage of them earn money from the amount of trades that they do, so they earn dealing fees. They're unregulated by the Securities and Exchange Commission, tend to be in offshore locations, very often on tropical islands. In terms of the sort of history, the sort of pioneers of the hedge fund industry that really gave it a good name. I'm going to start with Commodities Corporation, not strictly a hedge fund, but run by a guy called Amos Hofstetter. He had numerous traders that would go on to become successful hedge fund managers. So, biggest array of talent, I think, at any company ever in history. People like Michael Marcus, for example, Bruce Kovanar, Ed Sakota, just to name 3. Ed Thorpe, pioneer of algorithmic trading systems in the hedge fund industry with his Princeton partners, and the most famous of all, Quantum Fund with George Soros. Now, all the people I've just mentioned really did well. George Soros was the person who really brought hedge funds to the attention of the general public with just staggering gains. His big bet against the Bank of England netted $1 billion, his most famous trade. And an interesting fact about the Quantum Fund is between 1969 when it opened and 1999 when it closed, 100,000 investment in the fund would have grown to $420 million. So just truly fantastic performance. And Ed Thorpe and all the other guys I've mentioned, up there with Soros, okay? There were, poorly performing funds then, but the mystique and the way the public perceived hedge funds was a kind of, these are the really great performers of the investment industry. Now, that view still prevails to this day, but as we got into the late 90s, you had a lot of people just jumping on the bandwagon, so to speak, becoming hedge funds. Perhaps one of the worst was long-term capital management. They did have a great performance for a while, 40% per annum. They were vastly over-leveraged. They were extremely arrogant. They academically had an array of talent. I think they had 3 Nobel Prize winners, but risk management wasn't there. The fund blew up, went down. One of the biggest mistakes in financial history occurred when the government, the Fed, decided to bail them out. That meant that every big hedge fund or over-leveraged bank dealing fund that was looking at that bailout thought, oh, we're too big to fail. And we all know what happened in 2008. You had a massive bailout of the financial industry. It's a huge mistake. Also, you had the rise of the machines. I can't remember where I got that phrase from, but I think it's a good one. And the high frequency traders. So a lot of these funds engaging in highly technical trading and very short-term trading as well. Not making a great deal of money because their focus was too short-term. But I'll return to them in a moment, actually, because some of them do make big money, but you can never compete with them. But in terms of strategies today, it's a saturated playing field. Volume of money involved is massive. The pioneers could gain advantages of price discrepancies or the amount of money that they had. So let's take George Soros. The Bank of England were going to defend the pound. He knew they had half the money that he did with his leverage. So he was going to win. That doesn't happen today, or it won't occur ever, okay? Just simply because of how much money is involved in the financial industry and hedge fund industry generally. Now, if you look at how the hedge funds trade, you've got the global macro, longer term traders who seek opportunities anywhere in the world and trade longer term. They tend to be more successful in terms of generating money or money managed than the high frequency and the traders with the shorter term focus. Okay. Overall, the industry has performed abysmally. Just take this fact from Simon Lacker since 1989. If you'd invested in T-bills to today, you'd have beaten the average hedge fund by 100%. So dreadful performance overall. Obviously, there's hedge funds that do very well. The general perception of the public is, they mostly do well. They don't. I put BC minus 1.55%. That is Barclays Capital, who tracks hedge funds. At this time of me doing this video, year on year, that is what the average hedge fund has returned for investors. So they've returned a minus. Okay. Big problem with the hedge fund industry is most of them are focused on fees, not just the 2% and the 20%, okay, performance and management, but on dealing fees. And Lacker worked out that there were a huge amount of hedge funds that were generating as much as 30% of the equity they managed back in fees to themselves. So for $1 million, you get 300,000 in your pocket. Does it matter if the investor loses? No. You see numerous hedge funds close down, and the people who managed a really abysmal fund will appear at a newly launched fund with maybe a manager who is there, and the others are doing the trading. So it's a new manager, but they're really doing the trading. Saw a hedge fund do this recently. They went down, came back, they raised, I think, 400 million. Happens all the time. What lessons can we learn? Well, lessons you can learn are basically longer term is better. Look at the figures. It's the global macro guys who do better. Focus on the longer term. Avoid the noise. Avoid the shorter term. Now, technology does provide an edge in one area retail investors can never compete. High frequency trading makes a huge amount of money for the funds. That money is how quickly they turn over the trades and make the fees. So they do hundreds of orders in a microsecond. It's a lot of fees. They don't return a lot of money for investors, okay? But you can't compete in that area. I see a lot of people saying you can in YouTube videos. You can buy a high frequency trading system. You're going to need a good few million. Some of the best high frequency trading systems cost 100 million or more. You can't compete. Stay away from the short term. Also, they're after retail traders. They create a lot of noise. That's why it's not a good idea to go short term. In terms of technology, a lot of traders think, well, they've got all this technology, they should do well. Go back to the pioneer of algorithmic trading, Ed Thorpe. Throughout his trading career, When other traders were using more complicated algorithms, he was beating them in terms of return on investment. He once said, my algorithms are extremely simple. They have to be to make money. It's a technology. Forget it. It doesn't provide an advantage. Academia, well, let's look at long-term capital management. What went wrong there? That doesn't provide an advantage. The best hedge funds use simple trading strategies. George Soros always said, my trading strategy is extremely simple. It is. We've outlined it in videos. And most of the top hedge fund managers we've covered in videos, all simple trading systems, most long-term. What you can learn is that trading frequency does not increase your profit potential. Hedge funds have a fee focus, most of them. You don't have to, because that's not going to benefit you. What benefits you is doing good trades, patience, only waiting for high odds opportunities. So what you can learn from the best hedge funds is they do what the best retail traders do. There's no difference, okay? And I'm sure any trader watching this has the potential to beat that Barclays Capital minus 1.55% over the last year. And that's just a typical performance of hedge funds. So you don't need to be intimidated by the big boys. Keep it simple. Keep it long term, okay? Be very, very patient. Only take the best trades. And not only can you compete with hedge funds generally, you can beat the majority. Right, that is the video for today. Hope you found it informative. Thanks very much for watching me as usual. Take care and have a good day.